Mr. President, I just want to take a few minutes, if I can. I know we're in the waning minutes of going out of session, and members have, I think, by and large, probably respective states, and as I will be doing in a day or so, going back to Connecticut to spend time with my family and constituents over the Easter Passover break. But I wanted to take just a couple of minutes, if I could, and talk briefly about my responsibilities as chairman of the Senate Banking, Housing, and Urban Affairs Committee, in which I serve with 22 others of our colleagues, comprising almost a quarter of this institution who sit on that committee. Senator Richard Shelby is my ranking Republican member from Alabama, former chairman of the committee, I might point out. And we finished our work, at least in the committee, last Monday, in a rather abbreviated markup, I might point out. Not that I necessarily planned it to be that way, but we ended up with a pretty short markup of a fairly complicated bill. A week ago today, at about this time, a little after this, we had received amendments, had almost 400 amendments that were filed, and so I fully anticipated a rather elongated markup, but members decided that they weren't going to offer their amendments in the committee, which is their right. I had a responsibility as chairman of the committee to consider those amendments if they were offered, and we were prepared to either accept some, modify some, or reject others. But the conclusion of the committee was to take what changes we had made and move forward. And so it is my hope that shortly after our return on the second week of April, that we will come to the floor of the United States Senate to debate, hopefully in a full-throated debate, about how we reform the financial services sector of our nation. In light of the events over the last several years, this is a compelling issue that mandates our involvement and participation. We can hardly leave this Congress, leaving the door wide open again for the kind of abuses that brought our nation to the brink of financial collapse. And those were the words used by the Chairman of the Federal Reserve, Mr. Ben Bernanke, on September 18th of 2008, as they were the words of the former Treasury Secretary, Henry Paulson, when they met with the leadership of the House and the Senate and the respective leaderships of the committees of jurisdiction. They predicted that had we not acted in the remaining weeks of that session before the adjournment in 2008, that in fact we might have very well be looking at a very different country today. Certainly we'd avoided the collapse that they've talked about, but at great cost, Mr. President. The fact that this country and its taxpayers had to write a check for $700 billion, resources of which went to a handful of financial institutions to, quote, bail them out in order to preserve the safety and soundness of a fragile financial system, is something that still causes remarkable levels of anger and frustration, understandable levels of frustration and anger of the American people all across the country, regardless of where one lives. The idea that a firm on Wall Street could get near brink of disaster, get massive resources to pour into them, and then watch someone's home in Connecticut or Delaware or in Colorado or Tennessee or Alabama, a business closed, a home was foreclosed, a retirement account was evaporating within a matter of hours, despite the fact these larger institutions were getting the resources for the American taxpayer. Well, we've made an effort, Mr. President. I don't claim by any stretch of the imagination perfection to try and deal with the reforms. Obviously, it's a complicated matter, and the complications are added to that we have 23 members of a committee, not to mention 100 members of this body that all have their various views on what ought to be done, not to mention the other body, the White House, stakeholders and others, to try and fashion a piece of legislation that will not say that we're going to stop all financial problems in the future. That would be ludicrous for me to make such a suggestion. There will be other financial problems. What we're going to try and do with this bill, what we think we've done to a large extent with this bill, is to say there may be other financial problems, but never again should a financial problem of a major financial institution put the rest of the country at risk, because that's what happened. Because of their abuses, their greed, the failure of regulators, or the failure of the government to regulate certain institutions, we saw a system go haywire. Now, I don't mind if some firm wants to go to the casino and gamble with their money. I understand that. But the idea that they'd be able to do that with the taxpayers' money or with the well-being of our economy, that has to stop. And so our legislation is designed to do that. First and foremost, never, ever again should a financial institution that's so large, so interconnected, produce products that put the rest of us at risk. And our legislation shuts that door, we believe, firmly. Now, others are arguing because, frankly, they don't want to admit what the real argument is about. They don't like the fact we have a consumer protection agency here for the first time in the history of our country. So the people who buy a mortgage, buy stock here, buy an insurance policy, whatever else it may be, will have some place to go if, in fact, they're being abused. And that's exactly what happened. They were abused in too many instances. But rather than focus their criticism on that, they're focusing on other things that, frankly, we're dealing with very effectively in the legislation. We also set up an early warning system to the largest extent possible, so we know what's going on out there with products and firms that bring us to the brink of disaster, as they did only a few short months ago in that legislation. We're taking some of these exotic instruments, credit default swaps, derivatives, over-the-counter, an industry, Mr. President, that went from around $90 billion, and within the space of 6 or 7 or 8 years, close to $600 billion. It exploded, in large measure because it was in the shadow economy. That ends with this bill. It is going to have the glaring light of sunshine on them through exchanges. And all the American people and others can know exactly what these instruments are and how much risk is being taken with their use. Now, there are elements in this country that don't like that idea because they'd rather not have the light being shown on to examine what they are. But we're determined to see to it that's going to be the case in our legislation as well. Now, there are a lot of other provisions in a 1,400-page bill that deal with other matters related to all of this. And I just wanted to inform my colleagues, Mr. President, that we have a strong bill coming out of our committee, a fully independent consumer protection agency, Bureau Division. It's housed in the Federal Reserve in our bill, which has caused some people to wonder how independent it can be. It is totally independent. Its head will be appointed by the President of the United States. That head would then have to be confirmed by the United States Senate. The budget that this agency would have is going to be separate from other budgets that have its own line of funding to go forward. It has independent authority on rulemaking and on examination and enforcement with institutions that have assets in excess of $10 billion. And for those that are smaller than that, the examination and the enforcement will be done at the state level or others that would be responsible. Many were concerned that this would reach down to the community banks and others. We've separated that out. Many of my colleagues expressed that view. And that's going to be very important, that we have finally someone watching out. We were told for years that our system was safe and sound because they were making a lot of money. But as we've learned painfully, that isn't the only criteria to determine whether or not a financial institution is safe or sound. In fact, they were anything but safe and sound, despite their earning reports. We subsequently learned, of course, that people were put into homes they could never afford, didn't understand, because these institutions were securitizing those mortgages, bundling them together, and then selling them to unwitting investors, because they had ratings on them that never reflected the reality of what those instruments were worth in our country. And our legislation deals with that as well in a very strong and effective manner. So, Mr. President, my only purpose in sharing some few thoughts this afternoon before adjournment occurs is to say that I hope my colleagues and their visits back to their states and talking with their constituents will talk about these issues. Listen to your businesses on Main Street. Listen to the borrowers. Listen to the users and the customers of financial institutions. The institutions are going to call you. They're going to write you. They're going to find you, believe me, because many of them don't like what I've done in this bill. They'd like the status quo to be maintained. So you're going to hear from them, I promise you. And you're going to have to work a little harder to listen to the voices out there that may not contact you about this, but will tell you what it's like as they try to borrow money, make an investment, get credit, buy a home, get a student loan in order to afford the cost of higher education. And I'd urge my colleagues to listen to those voices as well. They deserve to be heard in this debate and discussion. And then we'll have that kind of, I hope, full-throated debate when we get back, meet with the other body with a final product, and hopefully give the President of the United States a bill worthy of the challenge before us. This is the single largest reform since the 1930s, and it is long overdue. But we must not fail in our obligation to meet the challenges. If we leave here failing to do this, we expose our economy, and the American public will never, ever again write a check as they did last in the fall of 2008. You can forget about that. And so we need to make sure that these firms that get in trouble understand the presumption is bankruptcy, receivership. Shareholders will pay a price. Management goes here. The idea that you're going to be able to count somehow on the American taxpayer pulling your chestnuts out of the fire are over with in the too big to fail concept. And the importance of achieving that goal along with these other reforms, I think will have the desired effect. Failure to do that leaves us exposed to the kind of financial challenges that we've witnessed over the last several years. And again, a business, as I say respectfully, in Connecticut or Delaware or Colorado, a homeowner in those states shouldn't have to pay the price because a handful of financial institutions got too greedy, too risky. They were unwilling to examine what they were doing, or did, recognizing that the federal government would bail them out if they made a bad choice, which they did. So, Mr. President, I look forward to that debate, discussion, and presenting the bill that our committee marked up on Monday of this past week. Mr. President, with that, I yield the floor.